Another close above 6,500 on the Nifty, but a flat day for overall market. Thanks for tuning in. You're watching Markets Tomorrow.
Hi everyone, and let's kickstart the show by telling you about our experts who will be joining in today. Well, we have on the show today Mahesh Patil, Fund Manager at Birla Sun Life, and there's also Sandeep Vagle, Founder and Managing Director at Apta Technical Advisory Services on the charts. Mahesh, I'm going to start off with you. What is it that you make of the kind of rally that we've seen for the equity markets? With the election overhang, globally things are looking a little bit wobbly. Is this kind of a move warranted?
Yeah, I think, we have been seeing at the beginning of the year, there's again a hope which has come up that you will see a broad recovery in the economy with elections. Okay, there could be renewed confidence coming back, both from the investment side. And in the interim, we have seen some green shoots in the economy, though it's still early days. We have seen the agri GDP pretty good. Export data has been picking up. But I think clearly, I think there is a belief that we are nearing a bottom. A bottom is being created. And we could look at for a new beginning, the new cycle in the economy as well as for the markets. And that's what is holding on our markets, despite the fact that the global news flow is not that great. We have seen good amount of outflow from the emerging markets. But I think India, in the global context also compared to the other emerging markets, looks a little better in terms of the outlook for the next few years. So I think markets, until the election should hold on. And depending on the election outcome, I think there could be some volatility. But I think clearly, we believe that we are seeing a bottoming out of process. A lot of the macroeconomic fundamentals, which were kind of negative last year, are at the margin turning a bit positive.
Sandeep, Nifty may be getting slightly jammed. The market breadth is divided, but the bottom line here is that dip buyers are still dominating Indian markets. Those who are buying stocks on every decline, they are feeling happy. Those who are not participating are feeling left out.
I would agree with you, Nikunj. After the decisive breakout which the Nifty gave in the first week of March, where we saw 6350 being taken out, and almost a 300 point move in that week, I think this should be expected. The Nifty consolidating, some sectors taking over from the other. The IT is taking a back foot, and some other sectors are moving up now. So in that sense, there is no element of weakness. There is no element of, yes, unless you talk of IT, yes, there is some more downside to be expected. We've been talking of this for the past couple of weeks. But it is very, very clearly taken over by the metal space as we saw today. So Nifty will be like that. Don't expect too much from the Nifty. I don't think 6450 will be broken, 6430 rather. I don't think 6620 will be broken in a hurry, or if that is broken, 6750 can be a good resistance. It may not move to 7000, 7200 in a hurry. That may not happen. But individual stocks and sectors will have their way. And you are rightly, as you rightly said, the bias is very clearly on the upside.
Nipun, let's get in your perspective as well. So much is hinging on the election impact and the kind of rally that we've seen in the currency markets, the equity markets as well. But is this move justified or overdone according to you?
Markets really move on anticipation. And when you look at the possibility that there could be a stable government that could come about, and which we've really seen 5 years of very limited action that has happened on the corporate front in terms of new investments, in terms of the relatively high interest rates and fairly low business confidence and investor confidence. So really there's something to look forward to as far as investors are concerned. The possibility that you could see that turning around significantly, and probably a possibility of an uptrend in terms of GDP, in terms of investment cycle and all of that, and which is probably clearly driving it. So I think, as Nikunj was mentioning, every pre-election there has been a rally, but really it is only in anticipation of the fact that the last 5 years, which have not been so great, will probably ensure that then the next 5 will probably ensure that there is that upward momentum that will create a different kind of growth momentum within the economy. And that's where FI's participation is happening. You're really seeing very limited retail investor participation that's actually happening. It's only traders which are probably cyclically playing various sectors, piggybacking on the sort of upward movement within the index, which is ensured by the FI buying various sectors intermittently.
Okay, it was all about slam dunk in IT. TCS corrected. First it was Infosys. Now TCS has clearly indicated and communicated that there are challenges in the current quarter. However, along with the latest communication, TCS has also indicated that FY15 will be much better than FY14. Nipun, if one really looks a holistic view at what TCS has indicated, TCS is saying that the current quarter would be bad, but FY15 will be better than FY14. So where is the bad news? What was the selling in TCS all about?
So I'm trying to figure that out as well. Single quarter is not something that can make a dramatic difference. When you've seen 3 quarters of good results, a single quarter which is not yet over or probably a few days left, but a single quarter is not going to make a difference. When you're really seeing that there is an uptrend, I mean, these kind of uncertainties do get created within industries probably for a few months or probably for a few weeks, but that doesn't really change anything as far as the entire industry is concerned. So our sense is probably a lot has been overdone as far as this kind of muted guidance that probably Infosys came out with or what TCS indicated. It's not something that is really going to change the growth pattern that we've seen. We've seen a turnaround as far as the IT industry is concerned. You're seeing US and the European economies ensuring that there are larger orders that are coming up, larger clients that are actually placing orders with a lot of these companies. So the business is growing. There are newer verticals that are there on which they can focus on, whether it is cloud or mobility or and all of that. So there are newer opportunities that are coming about. So our sense is something like this probably is overdone when you're likely to see that sustained growth or consistent growth as far as FY15 or beyond is concerned. Probably you are likely to see a sort of comeback by the IT industry. So our sense is on serious dips that happen on events like these, IT industry should be looked at fairly closely and invested in.
So let's keep it, sector and stock specific. And Mahesh, what do you like among, the cyclicals, the pure metal plays, cap goods, infra, or would you, like to diversify maybe into cement and traditional cyclicals like auto as well?
Well, in the cyclical space, we are positive on the banking and financial services sector, particularly the private sector banks. We feel that as the pickup in the economy happens, that should benefit some of the stronger banks in the private sector, and a lot of concern, which was there in the asset quality, especially in the large infra names, as we've seen some progress being done by the highly levered groups in terms of selling assets. So that should really ease the stress on some of the large corporates, and that should help the banks, especially which have got larger exposure to the corporate side rather than the retail side. So that's and again the valuations there are somewhere near the long-term average or even below in some of the cases. So I think there is a potential case for re-rating in some of the private sector banks, and that's a space which we are positive, though we still realize there is still amount of pain in the banking sector, and one has to be careful in terms of looking at banks, especially on the asset quality, and banks which need to capitalize and raise money to fund the future growth. Besides the banking and financial services sector, I think selectively we are also positive on the in the capital goods sector, companies where we see strong balance sheet and an ability to really capture the APU without compromising on the margins. So that's the sector where we believe, though we are not seeing any major signs of improvement in the order book, but I think clearly looking at the long-term potential in terms of spend in infrastructure capex, which could pick up post-elections, we feel this sector has a good potential from a medium to long-term perspective.
Sandeep, what's going on with Hindalco? I thought metal stocks were in a bear market, but Hindalco is only 6 rupees away from a 52-week high.
Well, Nikunj, well, Nikunj, very clearly, yes, Hindalco has been an outperformer over the past few weeks, or maybe a little longer than that. But if you look at even a Tata Steel, the pattern is very similar. On a strong bounce back mode, that is how I would describe it. And yes, I think Tata Steel and Hindalco, both of them should outperform in the next couple of trading sessions, or probably even in the next weeks or couple of weeks or so. I mean, I look at Hindalco as a clearly 130, 135 candidate from a 118, 120. So talk of a easily 8-10% trading upside. One can play for that in most of the stocks.
Nipun, how are you reading into the mid-cap banking arena? Because some would argue that now the NPA concerns are sort of behind them.
Well, we still have our doubts on the concerns being behind us as far as the mid-sized banks are concerned. Two or three indicators really. One, of course, a small indicator is the extent of advance tax paid by a lot of these mid-sized banks, which seems to be lower than what they had paid earlier. Probably and gives an insight into what kind of provisioning could be there for the last quarter. The second is the kind of restructuring that's anyway going on, and you're seeing the quantum of restructured assets constantly growing. So you're seeing provisioning on the one side, you're seeing restructured assets growing on the other side, and which is not a very comforting factor when you look at the fact that size when it keeps growing, and probably the possibility that a lot of those assets are actually getting sort of rolled over and actually could be seriously bad assets. So yes, it's positive that some of the borrowers are ensuring that their balance sheets start looking cleaner. But as far as the mid-sized banks are concerned, I think we're still probably about a quarter or two away where their overall assets asset quality could be better, could be probably cleaned up. That does not mean that you'll not see a rally. Sure. There has been a huge valuation differential that's been coming about between the private sector banks and the PSU banks, and also between the larger PSU banks and the mid-sized banks. So that's something that could get corrected. But in terms of asset quality, there still would be concerns for at least a quarter or two.
We're identifying some of the top stocks to keep on your radar. So let's get a 360-degree view from the dealing rooms, the technical as well as the fundamental perspective. Ajay is joining in from our research team with what the dealing rooms are betting on. Ajay.
Well, dealers are quite bullish on the capital goods space, and as a derivative to capital goods space, bearings company SKF India is somewhere where we understand that a lot of institutions are active. The stock has been gradually heading higher after the third quarter numbers, but we understand that a couple of funds have met the management and have come out with takeaways that there's further expansion in margins expected to about 19% in the coming quarter, and hence we understand a lot of nibbling by funds is happening. So keep an eye on SKF India. Apart from that, banking space all know that have been heading higher in the run-up to election. One expectation that probably the high beta is the area to be in. But one stock which is very quiet and relatively underperformed the entire space is J&K Bank, and analysts say that at a price to book of about 1.1 times adjusted, it is still at lower end of the valuations compared to some of the other private banks and the larger ones. So keep an eye on J&K Bank also. In the last 3 days it has traded sideways to negative. It was active in trade today, but dealers expect 80 to 90 rupee upside in J&K Bank in the near term.
Right, Ajay, thanks a lot for that. Sandeep Aglia, what are top ideas for tomorrow morning?
Nikunj, I would start with buying a Hindalco stop loss of 116, target of 130. Now, mind you, this is a trading target over the next few trading sessions. I won't be surprised if it goes beyond 140, 145 or somewhere nearer that, given a little more time. The second call is a buy in a Voltas, stop loss of 145, target of 158.
Nipun, where is it that you would find comfort in these markets?
Well, in a market where you are seeing momentum in different industries, probably in various cyclicals every 3 or 4 days, it is difficult to identify one space. But our sense continues to be on serious dips to take exposure to IT, and again on serious dips to take exposure to banking, the larger companies in both these sectors.
Mahesh, closing comments from you. You got some interesting names in your last declared portfolio from the oil and gas space. We all know of late that oil marketing stocks have managed to buck the trend. So are you a bull there? Are you a buyer there?
Well, in the oil and gas space, I think we have seen that some of the reforms, which the government started some time back. So there were initial skepticism whether that will continue. We've seen that continuing, especially on diesel price increase. And if that continues, then a lot of the balance sheets of these companies, which have been stressed because of the receivables, the working capital, which has been stuck. So that will improve, and that could lead to some re-rating over there. And even the government policy in terms of gas price increase, which should benefit some of the upstream companies. I think so. All in all, I think well, the valuations for the sector were always attractive, so that was never a question. It was getting more visibility and confidence that some of the policies which the government had mentioned, whether they will sustain, and that could lead to significant improvement in the balance sheet and the return ratio for these companies going forward. So I think it looks like even any new government which comes in, I think will continue with the current policies. And I think over a period of time, I think we should see better return ratios, ROEs for this company should improve, and that should lead to some re-rating. So I think that's what some of these stocks are factoring in. And again, we have been negative on this sector earlier, but in the recent past, we have increased actually because we gaining more confidence that some of the policies in terms of reforms will continue and are sustainable.